they cite prevailing market conditions, which kind of struck me as odd, given that the markets look very much like people want U.S. equities. Granted, this is not in the U.S. What do you make of this?
I think that's exactly the point. There's a dichotomy between outcomes in the U.S. and the rest of the world. So the market records you mentioned are U.S. market records. Valuations relative to the rest of the world are there's still a significant gap there in terms of their performance relative to fair value. I'd make a similar argument for the economy, where you have much more confidence in the U.S. economy sort of stabilizing at a below-trend growth through the middle of this year and then rising back to above trend towards the end of the year. It's much harder to make that argument elsewhere, and specifically for China and Asia ex-China. So some of those cracks that we saw or that we're starting to see in May in the IP data and sort of across a broad swath of Asian economies is eerily reminiscent of the supply chain panic you saw at the end of last year. Are we witnessing a replay of that as the latest round of tariff escalation roils through?
But the data seems like such a mixed bag here. I mean, one day we get data that says, okay, the economy's weak, and the next day we get data that seems to suggest things are a little bit hotter than maybe Powell gave it credit for. But at the end of the day, the market doesn't really run off of just data alone. It runs off of a narrative. And is that narrative, that global growth narrative, is that still sound, or are we just creating facts to sort of fit the narrative?
Well, I think you have different sub-narratives within that global growth narrative. One is, what is the risk of recession in the U.S., right? So what is that adverse state of the world for risky assets, equities, credit, et cetera, and how close are we to that? In that sense, we're still fairly comfortable that this year recession risk is low. The data you've been seeing in the recent few weeks have unambiguously supported that, and we put the conditional or put the probability of going to recession over the next 12 months somewhere close to its long run average or slightly higher, right? Which is actually not bad given that we are 10 years into this expansion. The second narrative, though, is that we have much more confidence in the U.S. than we do elsewhere. And so, U.S. growth going from 3% in Q1 to 1.5% or so in Q2, on its face is a fairly stark deceleration. But actually, domestic demand in the U.S. is pretty good. Consumption was weak in Q1, is accelerating now. A lot is made of CapEx and the demand side of the goods market. That's weak, but it's not catastrophically weak in the U.S. And the sources of weakness that we're seeing are inventories, which aren't growing as quickly, and trade, where you had a surge in imports in May. And so neither of those things gives an ominous signal for future growth in the U.S. I think the composition, so the internals of growth, are much better in the U.S. than the rest of the world.